We've seen a little bit of an uptick in volatility recently, and the importance of having a strategy has been raised as a big feature of those that are successful traders. Let's get some more depth now on this and how to formulate a strategy and how to go about that, bearing in mind our normal human traits. Well, joining us now is behavioral technical analyst Ron William from Intensity. Ron, welcome. It's great to be able to talk to you about this, and of course it's good timing because of where we are in the market cycle at the moment with this uptick in volatility. Just talk us through your thesis on this.
Well, the combination of behavioral finance or behavioral technical analysis with cycles is key. And as you just highlighted there, we're right in the eye of the storm in terms of the changing market regime and the importance of having both a market and mind strategy. So the three kind of key benefits as part of what passes the so what test for this approach is performance, risk, and strategy. So performance is all about the bottom line, positive equity curve aligned with our key development goals. It's the combination of both. Risk is most importantly risk-adjusted returns. If you take care of the risk, the reward then takes care of itself. But alongside optimized risk profile and bias mitigations, where we can actually go through the list of pain points and try and address them in some way, shape, or form. And then lastly, strategy, which is the name of the game, having a systematic process which can be tailored to our objectives and most important, adapted to changing market regimes, which is going to be a recurring theme throughout this discussion.
Break this down for us, if you can, in terms of some charts, just to give us some illustrations about where the market is at the moment.
Yes, so this can hopefully set the scene as to why what we're speaking about now is just so important. And so, case in point, look at the risk on recovery that we've seen post-pandemic in the form of Western equities, USA, S&P 500. The trend is your friend. But of course, until signs of reversal emerge, and the chart on the left, figure 1, shows that line in the sand, 50-day average broken for the first time in a year on a sustained basis, in addition to a reaction low. So that's early signs of a trend reversal. And that was earmarked by a DeMark exhaustion signal with a risk zone at 44.50, 44.40. And all of that is part of a contrarian reversal from sentiment extremes, both greed based on the options market and fear when we look at cash positioning. And that is further supplemented by the famous FOMO trade, fear of missing out, chart on the right, showing you Google searches at all-time extremes. But all of this, again, just to remind, trend early reversal as part of a late cycle move. And you can see there the chart on the right, figure 4, also highlighting that broadening pattern, which I've dubbed the Minsky risk to come if and when that late cycle wave 5 reverses down back to the old peak levels of 2020 and further lower.
How do we go about moving on from what we've already seen from you?
Well, it's a polarized environment right now because this linear trend spawned by a V-shaped recovery, central bank liquidity, and FOMO, as we just highlighted there, at sentiment extremes, has spawned this buy on the dip, buy on the dip, buy on the dip strategy. You can see there, figure 2, we had experienced less than a 5% or more drawdown in over a year, which is what really hardened the buy the dip opportunity. But then cross-reference that buy the dip opportunity with a potential falling knife risk if volatility continues to be elevated. And Jeremy, last time we spoke about this, we featured both the chart before and this one here on volatility pre-market shakeout. So it correctly predicted the recent move that we've seen. We will see up ahead in the month of September, October, and also year-end if lightning strikes twice, as my cycle models predict, and volatility on the VIX, figure 1, elevates to the 40% handle, as we saw October last year. And all of this basically should trigger a reassessment of our market and mind strategy, and that's what figure 3 and 4 allude to.
Number 4, first of all, because this bell curve, just explain a bit more depth about how this relates to what you're talking about.
Yes, so this is a probability distribution just highlighting what happens when high volatility triggers both positive and negative. And of course, the negative sort creates black swan events. Although that there's a lot of uncertainty and known or unknown risk, the idea is to consider a potential barbell strategy where you're diversified, you protect your existing profitable trades, but then you also hedge, potential event risk or just increase in vol. Options market is a case in point, or various other ways of doing that. But what's key is figure 4, recognizing the lessons from the Turtle book from way back when in their successful strategy. And that was in understanding the Darwinian rule of evolution, adapting to change. It's not about being the strongest or the fittest strategy in the market. It's about adapting to changing market environments. And so what we have here is 4 different market states with different trend direction and levels of volatility. On the left, stable and quiet, trending and quiet, but on the right, stable and volatile, trending and volatile. And so the opening question I asked all audience members to consider is which markets fit each of these regimes, and how, currently and maybe what would that do to your market in mind strategy going ahead? What would you change from both the market strategy and the behavioral mindset? And most people get caught out when they expect the same trends to continue forever, and they haven't prepared or done any scenario planning for any change ahead. And remember, in life and markets, change is the one and most important constant.
This is the problem, isn't it? Because when you get to a certain point in the market, be it up or down, it's very difficult to work out when we've gone too far. This is fear and greed sort of balancing act, isn't it? And when to change your mindset.
Yes, and it's all about probabilities as much as it is about emotional extremes, as that pendulum swings from one end to the other. And so there are no certainties, only probabilities. But there's also risk and reward that we have to remember as part of that changing profile along the market cycle. So that greed fear cycle that we all know about from one extreme to the next has a risk reward profile to it. The optimal time is, you can see there as part of the traffic light system in the middle, but we often get more excited when we can get rich quick in the more higher risk red zone. And the issue is, of course, the level of emotional intensity is at its highest and the risk of ruin is strong. So we must always remember at these extreme points, both from a behavioral, technical, and macro or fundamental, whatever view we look at, the words of Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. Easier said than done, but if we can at least always remind ourselves of having our biases in check at these extraordinary extremes, and at least consider a diversified barbell approach when we're unsure about the road ahead.
That makes it very, very simple. And I mean, if it is so simple, why is it ultimately so challenging?
Yeah, so there are different ways of answering this question, and what's important is to be curious enough to know that we need greater awareness, either from a psychology point of view or from a brain mechanics, and I'd like to blend both. And this diagram here highlights very clearly a well-known concept, which is the asymmetric relationship between risk and reward, or pain and pleasure. It was made famous by Daniel Kahneman, the Nobel Prize winner within the behavioral finance space. And it shows that the pain of loss is twice as great as the pleasure of an equal gain, i.e. if we were losing 1,000 pounds or dollars versus 1,000 gain, we would be focusing more on the loss than the gain times 2. Now, the main reason for that is our survival programming based on the amygdala hijack trigger, basically a certain small emotional alarm system when our brain gets triggered when we're under stress, and that semi-paralyzes the logical part of our brain, which makes us do subpar decisions and, of course, mistakes, and then a negative hit to the portfolio. That's what happens. But what that does is it makes us cut our profits too early and hold in our losses too long. That's the practical mechanics of it. But also on the reward side, we do suffer from the dopamine effect, which is all part of the motivation and greed, or fear and greed equation. Neither extreme is recommended. We do need to be able to be in the zone and find a balance. Greater self-awareness on the psychology side, as I mentioned, but also on the brain mechanics, do know that there are certain neurochemicals like endorphins that can be produced when we're in a positive state. That can also help with pain relief. A simple 20-minute walk has been proven to give us more of what we need when we're at either extreme of too much dopamine or too much cortisol when we're feeling the stress. And the last chart 4 just also highlights just being in the zone, what that means from a biochemical point of view. That is a harmonic state. Sounds scientific, but all it is just a very calm state of being. And when we're in that, more often than not, we can be focused, we can be disciplined, but we can also make difficult decisions during uncertain times. And that's contrasted when we're going into a negative downward spiral. That can create lots of issues for us, which is harder to mitigate.
Is there a different response depending on one's age? I mean, I'm talking from a point at which I've been trading the markets now for close on 15 years. And as I get older, I do appreciate things differently. Part of that, I guess, is wisdom. But does age have a different response to all that you've been talking about the brain's functioning?
Yes. So from a brain perspective, a concept called neuroplasticity suggests that the brain is a muscle, and the more we use it, the better it can evolve over time. That also goes the other way: use it or lose it, just as if we would go to the gym. But from a psychology point of view and investment preference, and as you say, wisdom, the older we get, the more experienced we are or should be from other market cycles, especially the big ones that create the strongest impact. And also our investment preferences shift to high performance and high risk to wealth preservation. So that's what we see here on the chart, the big chart on the left. The silent generation, those who are 70 years plus, tend to be more prone to loss aversion. They don't want to lose money, and they want to preserve capital. That's stating the obvious. Most people will know that. But what's new and more of a quirky insight is that the younger cohort, millennials and Gen Z, especially those who are new traders, first time since COVID-19, have been experiencing a lot of the FOMO condition, fear of missing out, partly spawned by the crisis opportunity. Remember that lockdown situation, lots of time on our hands, government checks, but then also low barriers to entry in terms of zero commission brokers, and a linear trend with leverage to boot. So in that situation, the strong pain point biases, according to this data analysis, is herding and recency bias. Remember, herding is what creates bubbles that burst and crash. Recency bias is just basically expecting yesterday's trend to continue tomorrow. And both are not good at extremes. And if you see figure 2, the main reason behind this is because a lot of people who've just started trading in the last year or so haven't experienced a traditional bear market. And when I say traditional, I don't mean in terms of price magnitude, because we did see a 35 to 40% crash in most markets around the world, if not more. Historically, we have not seen a traditional time duration bear shakeout, which is about 2 to 3 years. And so you can see the figure 2 comparing 2020 as the fastest bear market ever when we look back over 100 years. And figure 3 just gives you the visual on there, that sharp V-shaped recovery. We didn't even get a base formation or any kind of sign of accumulation. It was just straight down and straight up panic selling, panic buying. And that's been a great money-making opportunity for many people. But the younger cohort, I think, haven't had the market experience yet of a few traditional bear shakeouts to know how to adapt to that changing market environment. And of course, my hope is that we all learn how to adapt quickly if and when markets change.
And of course, the thing about that is it's not just markets, it's the fact that the millennial generation haven't seen rising interest rates as well. So that's something else they've got to contend with at the same time, something that you and I, of course, have seen both on the upside and on the downside. Just talking a little bit more about missing out on some market moves. Someone of my age, I know I'm talking to a lot of traders in my cohort, they've missed out on some of what's been happening in the markets recently, which millennials, of course, have benefited from. This idea of going into stocks that, quite frankly, us older traders didn't even consider as being an opportunity. And I know that you've got a chart coming up now showing us this difference between what we've now come to know as meme stocks.
Yes, and I've later on dubbed it the rock and roll investments. Never mind single digit, double digit. It's now triple digit. We can get rich quick during crisis opportunities, but of course it comes at a price, and that's the prudent message that I hope to share with everyone. David did beat Goliath momentarily as part of the GameStop effect that we all have heard of, but the open question is at what price? And what we see here on the chart on the left, based on data from The Economist, retail so-called dumb money, and I say that with respect, that's a well-known phrase, did beat smart money. So David versus Goliath, a biblical reference, both in terms of the GameStop effect, but also in terms of trading volume. And that's the chart on the left. All that just shows is at the margins how big the liquidity footprint was and maybe still is. But let's look at where the money flow has been since. And figure 2, as you quite rightly highlighted, is part of the hot money rock and roll investing opportunity, which, yes, some people have missed out on, but a whole bunch of others actually either did well or at least experienced it in some way, shape, or form. You can see there the MEM index based on Bloomberg data, greed on the way up, but then fear all the way down year to date in 2021. And so that's the post-party effect. It's not a straight line up. There has been some changes and some risks that come with it. And so that really is the price that every cycle has. And figure 3 just shows, some of that easy opportunity, not just in terms of easy money and low rates and government checks, but also in terms of low barriers to entry broker platforms like Robinhood, which are now potentially having profits at risk from this FOMO speculative environment. So you can see that Q2 versus 2020 versus 2021, which probably got a big hit after the crypto crash, with all the exposure that they had built up through that time.
Okay, so let's just wrap it all up and take a step back and talk about the strategy. How should we approach this?
Yes, so ultimately, we can all benefit from a market in mind strategy, being as successful as we can be, especially during changing environments, or as I've earlier referred to it as the VUCA environment, volatility, uncertainty, complexity, and ambiguity. And the best way to do that is to consider this A-star strategy: assess, accept, aspire, act, acts, and add. It's a long-winded kind of way of remembering key principles. Assess is make your market in mind assessment right here and now. Look back at the period that has gone. Identify those vital signs in terms of your performance, bottom line, equity curve, the risk profile, the strategy, and also don't forget the psychology side of things, which is the greater lion's share, mindset and biases that we need to keep in check in order to maintain our edge. And any of the key lessons we should then start to incorporate into that new forward-looking strategy, particularly as we look at the year ahead. Except this is something I find is a real issue for clients that I do training with and coach, accepting and getting out of a state of a denial and certainly frustration and anger or revenge trading. Accept what you can't change, like, for example, the disruptive environment originally triggered by the pandemic, but change what you can't accept. Just the fact that markets do change and this linear trend may reverse and volatility will likely rise. That's something that we have to accept. Market's very polarized right now. A lot of buy the dip or buy and hold people, or just Armageddon, people looking for a real bear market crash. Forget the extremes and just think about accepting change and what you would do from a market mind perspective. Aspire, third, following, to enhance your edge. Remember, your edge is only as good as the last time you've actually reviewed it, field tested it, and sharpened it up for the changing market environment. Many traders who have made money with an edge can still lose the edge over time. So it's really important to avoid strategy drift or just redundant strategies over time, especially as trend direction and volatility change. And then remember, of course, to innovate and to deepen your learning curve. And the last three, actionable steps, convert into systematic process, which needs to be disciplined in terms of how you follow up. And acts, most importantly, everyone talks about having a checklist of things that we need to do in the trading and investing world. How about having a checklist of things that we don't want to do in terms of the things that really hold us back? Stop or reduce trading mistakes. I recommend people doing mistake analysis and add a monetary figure to it, just to have a real idea of how much that's hitting the book, and so how performance can improve as a consequence. Check those behavioral biases and always be aware of them. And then finally, add. In order to act, we have to add or replace that old pattern with a best practice mental strategy, and certainly a peak performance during these disruptive and stressful times, so that we can be the best in this game of trading and investing.
Okay, Ron, all right, thanks so much indeed, running through a strategy for these volatile times. That's Ron William from IntentG. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.